Hello and welcome to Millennial Money Mindset. If you want the fruits, you need the roots. Today we're going to go through the 7 habits or 7 big mistakes people make with their money. So a bit about myself. So my first vivid memory of money was during the 1990s recession, and I was swimming in a sea of pound coins, like the character from Scrooge McDuck. It was during the 1990s recession. I was 8 years old, and it was very similar to today. There was people that during the recession, lots of people had lost their jobs, lots of people, the market had crashed, and lots of people were out of work, and it was kind of scary times, quite similar to today. I had saved up money it was during a jumble sale. Basically, I'd collected old clothes, old toys, and old unused, wanted appliances, and essentially we'd sold them at a jumble sale to raise money for a scout bus. And it kind of instilled in me that you can make money in any market, and it kind of showed that to make money, just add value to people. So essentially I took old unwanted clothes and moved it to a jumble sale, and I made my first £20 in business by selling a pair of Nike Air Maxes by basically bought them at the jumble sale and then sold for £10 and sold them to my friend for £30, and I made £20, and that was my first £20 ever made in business. So stay right to the end, because we're going to go right through the 7 biggest mistakes people make with their investing and trading. So the first one is greed. So we're all a little bit greedy, and it's the desire for material gains. So we're all humans, and essentially lifestyle is different for everyone. So we can choose to have a big lifestyle, or we can choose to have a small lifestyle. So when we think about it, after health and family, lifestyle is all we want in life. So the most important thing is to understand your number. Now, essentially your number is how much you need to be financially independent and retire early. And I've got on YouTube, I've got a video that breaks it down, that gives the mathematics on how to work out how much is your number and how much you need to live on for the rest of your life. And once you know that, that's going to give you a massive peace of mind that you are financially independent, and then you can actually focus on what's important in your life. So, but the number one mistake is to be greedy. So we're all human, we're all greedy, and it's actually understanding what our lifestyle is and making sure that lifestyle creep doesn't creep up. So we have our income, and then making sure that our expenses doesn't creep up. It's actually being disciplined and actually controlling our expenses. That's the first mistake I see people making. So the second mistake is being envious. So envious is the desire for other people's wealth or status. So essentially we're all human, we're all a bit envious. And today it's kind of normal for other people to be on social media showing their new possessions, cars, TV, swimming pools, etc. And Instagram's terrible for this, because essentially we see other people showing off their material gains, and essentially a lot of people, you realise that once you meet these influencers, they've bought it all on credit, or they don't actually own the cars that they're showing off. So I've been guilty of this myself. I missed the boom in the property in London. So London house prices have risen 500% since the 1990s, and I got gazumped a couple of times on buying properties. And yeah, you see other people at dinner parties, or hear other people at dinner parties saying how much they've made on their property. And at the time I was quite envious, but it's all about having time in the market. And I've now waited out, being patient, and I've bought a property in Bristol, and I also bought a property with my partner in Oxford as well. So it's not about getting it straight away, realizing that being grateful for what you have and imagining what people were living like 100 years ago, they'd be amazed at what we have today. So essentially the lesson here is being grateful for what you have, and don't look at other people. There's a quote that's saying that comparison is the thief of joy. And essentially when you compare yourself, especially social media is really bad for this, when you see other people on social media showing off what they have, you realize actually these people aren't as happy as they portray themselves on social media. So it's just really making sure that you understand that being grateful for what you have, and not kind of getting caught up in the kind of the sea of social media that can kind of make us feel that we're envious of other people. So the third kind of mistake I see people making is kind of being pride. So it's essentially pride is thinking you know everything. So we often don't know what we don't know. And it's being pride is essentially, it's pride comes before a fall, and it's thinking we know everything, or being afraid to ask a silly question, or coming to ask for help. So pride, we're all humans and we can be proud creatures. We often don't like to ask for advice, or we don't like to admit when we've made a mistake or when we're wrong. And often pride is an excessive belief in one's own abilities. So in all markets, there's no perfect information. So we don't know what we don't know. No one can predict what's going to happen. There's too many, there's hundreds and thousands of different choices being made, and there's no one person can predict what's going to happen. There are too many random events, and it's possible to know what's happening all around the world. But this is essentially why financial education is so important, and it can stop you, and it helps you stop you from becoming overconfident. So pride often becomes before a fall, and it's trying to take too many risks or not understanding what risks you're taking, which can cause financial pain for yourself and your family. So essentially, education is the key, knowing yourself and your principle and what you want out of investing. So investing is not about trying to time the market. It's not trying to predict what's going to happen the ups and downs. It's actually knowing yourself and knowing what you want from the market, rather than trying to predict what's going to happen in the market. So once you know yourself and knowing where you want to get to, that's really powerful with your investing. So education is key. Knowing yourself and the principles in investing help reduce your risk. So the next deadly is sloth. Essentially, it's avoidance of work. So this comes from not doing your own research or taking time to learn how to invest. So investing is a life skill, and it gets better by practice. You learn from others. Just think of it like riding a bike. No one knows how to ride a bike initially. It takes time through practice, but through practice and experience, you get better and better and better. And you start to think, when you've been riding on your bike for a number of years, you don't even think about it. You don't even worry about it. You don't even stress about actually what you're doing. But those that kind of initial time when you're starting to, like any life skill, ride that bike for the first time, it is quite scary, and it's quite wobbly, and it feels quite insecure. And like those pedals, that inertia, that first movement is always the hardest. So once you kind of move those pedals and it starts going, it gets easier and easier and easier, and that momentum gets built, that kind of works with you. And then every action kind of is an equal opposite reaction. So the more you pedal, the faster you go, the faster you pedal, the faster you're going to go. So think of it as the same as investing. So it's just, investing is a life skill. It gets better by practice, and you learn quicker through others. So rather than, it's much easier to go down the pub and hear someone's tip on what cryptocurrency they're buying now, or what kind of penny stock they're buying. But it's much better to do your own research, understanding the fundamentals and basics of investing, and that's where you're going to have much more success in the long term. So investing is more about understanding yourself and then understanding different companies. It's not about it's not about finding out what the different companies are doing. It's more important to understand what you want from the market, what your aims and objectives, and where you want to get to. So the third deadly sin is gluttony. So essentially, it's consuming more than our desire to consume more than we require. So investing is a long-term process. So there's a difference between investing and difference between trading. So investing is a long-term process. It's buying assets, living, breathing companies. Like, walk down the high street and there's these companies, these businesses are there selling goods and services. They're there to solve a problem. So this might be companies selling medicine. This might be companies selling food. This might be companies giving a service like hairdresser or these things. These are all businesses that are actually producing goods and services. Whereas trading is different. Trading is looking at lines and the ups and downs of the market, trying to time the market, trying to predict what other people are doing. Each one isn't right or wrong. They're just different strategies. They're different strategies and different techniques that are going to be successful. So speculating, like trading, is short-term process, trying to buy on the hope that someone else will pay more for that stock or share. Where it does get dangerous is if you're buying on credit, or where you're essentially, there are a number of different brokers or when you, these investing platforms that will lend you money to speculate or lend you money to trade. And essentially you're using these, and essentially, which is fine when the market goes up. When the market goes down, they're going to want their money back. And if you don't have the money to pay them back, they're going to charge you high interest. And also when they're leveraging. So quite often on these trading platforms, there's a number of leverage positions. And leveraging, all it means is essentially you're buying, it's like a mortgage. When you borrow money from the bank, you can have, say, you can buy a house for £100,000 with only a 20,000 pound mortgage. And essentially you're using that bank's leverage like a lever. You can get more for your money because you're using the bank's leverage. But what they do in investing, there's a number of different investment platforms that offer this leverage, and it can get really dangerous, these leverage positions, because it works fine when the market goes up. But if the market comes down, you're essentially got to pay that, your money that you've borrowed back, plus the money that you've lost as well. And people can get into real trouble. And essentially the 1930s crash, the crash in the 1930s was caused because people were borrowing money to speculate. And all these people borrowing money, and then they couldn't afford to pay it back when the market came crashing down. And then the brokers came asking for their money, and people couldn't pay that money. And essentially loads of businesses went bust because of that. So it's super dangerous, and just be aware of that. If you are going to leverage, make sure you've got a stop loss in. This is more trading than investing, right? So you don't lose, you know how much risk you're taking. So if you don't have the money to trade or bet someone else's money, don't do that. There's a difference between good debt and bad debt. So good debt is essentially borrowing money to buy a house, for instance. You're buying an asset that's going to over long term, it's actually going to pay you back. Whereas borrowing money on credit or a credit card or borrowing money to speculate gets really, really dangerous. So seek counsel when you're and considering the differences. So that's number 6. So number 7 is, this is number 6. So wrath is extreme anger. And there's a danger when investing or trading because it can be emotional. So I used to trade gas for a FTSE 100 company, and it gets quite emotional when you're trading. There's part of the brain that gets, there's a chemical that gets released it's called the amygdala, and essentially it's when there's danger, there's like a fight or flight chemical gets released, and it causes us to panic and sell at the wrong time. So it's a thing called it's the same as if you walk in the woods and there's a scary bear that runs out on you. What kept us alive in the old days or even today is this chemical get released because that meant we can run away from this scary bear. The same happens when there's a bear in the market. So when the markets crash, the same chemical gets released. It's our kind of ancient evolution that's kind of causes us for this to happen. And we have to be aware of this, that when we're investing and the market crashes, there's a lot of panic, there's a lot of stress and a lot of kind of worry. And we think we can handle this in the good times, but we don't realize that this chemical is going to get released in the bad times. And this kind of causes a frenzy of people, especially lots of people in the market, and it causes a lot of people to panic and sell. And this can be kind of a big danger. So you have to, but kind of knowing this is a good way to kind of prevent this. So it's different between getting emotional, what you can control, and what you can't control. So we all have an individual sphere of influence, and getting angry about what you can't control is useless. Don't worry about that. If you lose your job to redundancy, that's kind of don't worry about that. Just kind of focus on what you can control and understand there's opportunities in any market. So you can focus your energy to discover this opportunity. So just coming back, so investing can be quite emotional, and to know this emotion, it's super important. So there's a really good book called Emotional Intelligence, which goes into kind of the chemicals in the brain that get released. And there's a lot of kind of other good books. There's a book called Thinking Fast and Thinking Slow, and it talks about the different kind of makeup of the brain. I've got a YouTube video that goes into kind of the makeup of the brain. It kind of goes into it gives you kind of tips on that book, Thinking Fast, Thinking Slow. And yes, that guy won a Nobel Prize in economics. So there's understand that we're emotional creatures, and we kind of get caught up in this kind of emotion. And then finally, the seventh deadly sin is lust. So we all love a story. We all kind of appeal to the human part of the brain, and we often get caught up in the love of a story. So this is kind of this may be Steve Jobs coming back to Apple, and to save the company when he created the iPhone, or kind of the potential of blockchain technology, Bitcoin. And people get swept up in this kind of emotion. We like to tell our friends about it. We like to think we're going to be right. However, from an investment point of view, this can be dangerous. We're kind of, humans we've been wired to be terrible investors. So don't buy one. If you're investing, don't buy one stock. Don't buy one stock like Apple or Tesla or Facebook, because we can kind of get caught up in the emotion of this stock. We get caught up in the story of this stock. So it's much better if you're investing to buy like an index tracker that tracks the whole market, or to buy a fund which is a basket of 50 or 60 companies rather than one. And it can reduce our risk by 60% by buying a basket of stocks or shares rather than buying one company. So what I do, go through the 5-step method to money mindset, which is essentially own yourself first, set up an automated payment to yourself. Own yourself first by being proactive, be responsible and paying yourself first. Have a 3-month cash buffer. So having for any emergency, so if there is a crash, then you don't have to sell at the low. You can essentially use that cash buffer to pay for any emergencies. If the car breaks down, if you lose your job, if the boiler breaks down on a property, then you can use your cash to essentially pay for the bad times. Bad things happen in life, and if you have a cash buffer to cover this, then you don't have to kind of dip into your savings. Well, you don't have to sell at the low, essentially, and then you can wait for it to ride out of it. Have a 5-year plan, know where you want. In all my courses, we have a life plan. We know kind of where you want to get to with your properties, with your career, with your lifestyle, with your family. And that helps with your investing. So remember, you're investing, it's much more beneficial to think that why you're investing. You're investing think of the stock market like a tool to get, just like a tool or a technique to get from where you want to in life. It's not about trying to predict what's going to happen. You're using the market to essentially use it for you, for your own gains. So I have a course called Performation Asset Allocation. It's called, it's a book, and you get a card game, a workbook. So what's the price of education? It's essentially you're essentially investing for yourself. And essentially we can teach you how to invest in 90 minutes. We go through all the best techniques in 90 minutes. And essentially it's a card game that teaches you how to invest. So we use the Sustainable Development Goals, which is essentially we pick 2 of these. And essentially what I pick is life on land and quality education. So pick a goal for your head and one for your heart. And so in any business, so for any book that you buy, we plant a tree. And for any course that you buy, we plant 5 trees. And our aim is to improve good quality education. So for Performation, well, let's go through the 4, essentially you offer 4 levels of service. So bronze service, silver service, gold service, platinum service. If you want the one-to-one service with me, essentially you get all the other packages, but you get 3 meetings with me. We build your own Performation asset allocation. You check your pension, look at your assets there, your asset allocations, check how much you're paying in fees. We'll look at your insurance. We look at your risk profile to see how much are you low risk, high risk, and we build your portfolio around you there. We look at your psychological profile to see how much you look at your mindset, give you a personality quiz. We also look at this Japanese concept called the Ikigai, which essentially, once you become financially independent, what do you do with your time? And essentially your Ikigai is the Japanese concept, which means your reason for being. And essentially it looks at what you're good at, what your strengths, where is there a demand, where can you get paid for, and essentially what the world needs. And essentially it builds this kind of platform, and it says actually where can you make the greatest contribution, and then you can focus on that. And then we also teach you how to trade, how to invest, and how to start a side hustle. That's the platinum package. Gold package is essentially we're building a community, and it's a monthly, so 12 monthly group calls to build a community. Every month we build an environment of people where they can think about different investing strategies, and we kind of come together and speak about different platforms, different any opportunities. There's 12 video books, a day accelerator. We're going to bring in world-class speakers, and we have a card tournament. It's a networking session. You get a coaching journal, you get some bonuses, start your own side hustle, productivity course, making your first profitable trade. These are all learning courses, and you get a ticket for the World Cup tournament, the football formation, asset allocation card game. And then this is the football formation. It's teach you how to invest, card game workbook, online course, budget spreadsheet, life plan. Or if you just want the bronze package, there's a free how to automate your finance to get more me time. Just write in the comments below if you want to, and I can send that to you. Or there's a book for £7. It packed full of value. It's a Financial Times shortlisted book, and yeah, it's packed full of value. Or check out my YouTube channel. There's over 100 videos there that all giving value. Or my podcast, Millennial Money Mindset, or the YouTube channel is called Millennial Money Mindset. Or if you're on TikTok, I'm Money Tips. With tips is spelled TIPPS, and there's over 100 videos there. So thank you so much. And any questions, write any comments in the any questions in the comments. What was your main takeaway? Which of the 7 of the mistakes was most impactful for you? And were you making any of those mistakes? Would you add any of those? So my name's Neil Doig. This has been Millennial Money Mindset. Please like, please subscribe, and please tell a friend. Thank you so much.